It's been a very busy couple of days for US and UK economic data, which means we've seen plenty of volatility in the currency pair, but also in interest rate expectations for both. Inflation data in both cases has been released over the course of the last 48 hours, and there's obviously been a sharp focus on that because we are nearing the end of both tightening cycles from the Bank of England and, of course, the Federal Reserve. But we've also had labour market data from the UK and retail sales data from the US. So first, let's take a look at those pieces of data and see what the main takeaways are. We'll start with the US. The inflation data was stubborn, to say the least. We saw inflation still declining, but at a lesser rate than what was expected last month. And also the core inflation in particular was quite stubborn also. And that's going to be a concern for the Federal Reserve, the simple reason being that they have been concerned up until this point about inflation. It's actually the markets that have been a little bit more relaxed on that particular matter. But if we're already seeing stubbornness at these very high levels, then that could potentially indicate that there's much more difficulty to come. Then we have the retail sales data yesterday, and that's going to really pile in on the narrative which formed following the inflation data. The resale sales data showing strong growth in January. Now, we were already expecting quite strong growth at the start of the year. We had cold November and December, which weighed on retail sales, and January was unseasonably warm, so it was expected that we were going to see a strong bounce back, but it was much stronger than expected again. And that's going to feed the narrative again, like I say, that we're still continuing to see strong demand at a time when the labour market is very strong and wage growth is quite strong as well. Add to that the non-farm payrolls, which we saw earlier this month, and it paints a very strong picture for the economy and a very resilient picture for the economy, one that isn't going to encourage the Fed to pause after just one rate hike unless we see a significant change in the economic data over the next 2 months. Then we take a look at the UK data, and again, we're seeing signs of relative strength, although not to the same degree. We saw the labour market figures were quite strong. We've seen inflation data was actually a little bit better, and that's come as a big upbeat for UK markets. The pound actually pulled off quite considerably yesterday on the back of this data because we saw inflation falling to 10.1% and core inflation falling quite far as well. Now, 10.1% is obviously still far too high, more than 5 times the Bank of England's target. But the fact that we're seeing disinflation at a faster rate than it and the markets expected is obviously a plus. And it was with these considerations prior to this release that the Bank of England still expected inflation to fall to 4% at the end of this year. So if we see this become more of a trend, and this isn't just a one-off or two-time blip in the data, then we could potentially see it actually beat on those forecasts. Now, it's also worth noting that these forecasts are projected much further ahead, and that's been notoriously difficult over the course of the last 18 months. But this would suggest that we're at least a little bit ahead of the game on that fact, and that's why we saw the pound come under so much pressure yesterday. What both of these things mean for expectations is a little bit different. From the Fed's perspective, markets are now pricing in 2 or 3 rate hikes this year and probably no rate cuts this year. And again, that's probably going to be changed a lot over the course of that period of time. But when you compare that with 2 weeks ago, just before the jobs report, the markets were then pricing in 1 rate hike this year and 2 rate cuts later in the year, then that is a very, very significant change, more aligning with the Fed rather than the Fed aligning with the markets. I do think that will be subject to change over the course of the next 2 months, but this collection of data really has forced markets to reprice those expectations. The Bank of England, on the other hand, we're seeing expectations pared back slightly, and that's why we saw the weakness in the pound yesterday, and that is also why we are seeing slightly lower gilt yields on the back of that inflation data. Again, I do think it's going to remain volatile, at least over the course of the next quarter. So let's take a look at what that ultimately means for the pound-dollar pair. And as you can see, plenty of volatility over the last 24 hours. We did see that sterling weakness yesterday. You can see the big red candle here. It hasn't changed the dynamic overly as in this currency pair, in that it still continues to trade in that 120 to 124.50, 125 zone. This is obviously quite a wide range and puts into perspective the size of the sell-off that we saw yesterday, around 1.5%. But I think the most interesting thing from a technical standpoint is it's still around 120, actually bouncing back slightly today. But that cluster of moving averages is holding firm. And that is important because the breakthrough to 200, 233-day simple moving average band, having already broken above the 55, 89-day simple moving average band later on last year, for that to continue to hold suggests that we are still in a bullish pattern. If that 120 gives way, it's not just a big technical level that we're seeing give way. It's also those moving averages as well taking us back into bearish territory. So that would be a significant technical breakout for more reasons just than the 120 alone. So I think that's going to be the key to watch here. If we see that 120 go, then that could suggest we're back in bearish territory. But at this point in time, it is holding and it is rebounding today. The strength of the rebound may give us some indication as to what we can expect over the coming days and weeks. But ultimately, it's all going to be driven by the data, especially given the collection that we've just had this week.